Okay, let's just get right into it. For millions of us, the equity in our home feels like a safety net, right? It's like this hidden savings account we've been building for years. But what if tapping that account today is less like making a withdrawal and a lot more like setting a trap? Today, we're pulling back the curtain on the real risks of a home equity line of credit, or HELOC.
This quote, this right here, is the heart of the whole thing. It comes from a homeowner in Atlanta, and it just nails the psychological trick a HELOC can play on us. See, it doesn't feel like you're taking on debt. It feels like you're just accessing value you've already created. But as he and so many others found out, that feeling can be incredibly misleading.
For that same homeowner, his payment shot up from around $275 a month to over $1,000. Wow. And listen, this isn't just some unlucky one-off story. It's a direct result of how these loans are designed. So in this explainer, we're going to show you exactly how that happens and what you absolutely need to know to protect your single biggest asset.
To really get the risk we're facing today, we've got to rewind the clock a little bit. The entire financial world has been on a roller coaster, and variable rate debt like a HELOC, well, it was sitting in the front car.
Just look at this number. Not too long ago, back in 2021, early 2022, you could get a HELOC for around 2.75%. I mean, that's practically free money. It felt totally risk-free, and you know what? Millions of homeowners jumped on it. And then bam, this happened. By late 2023, the interest rate on that exact same line of credit could have skyrocketed to over 8%. Just think about that. Imagine your rent or your car payment tripling in about 18 months. That is the brutal reality of rate whiplash. And this is the engine that drove the whole thing. See, HELOC rates are tied directly to something called the prime rate. And as you can see, starting in early 2022, the Federal Reserve slammed on the brakes with 11 aggressive rate hikes in just a year and a half. They were trying to fight inflation, and in the process, they pushed the prime rate from a low of 3.25% all the way up to 8.5%. That's what sent those monthly payments through the roof. So let's be super clear about where things stand right now. Even though the prime rate has cooled off a little, HELOC rates are still high. This isn't the cheap money of 2021. This is expensive, variable rate debt, and it's secured by your house. Okay, so here's the deal. The danger isn't just about that high interest rate. Nope. It's actually about three specific, kind of sneaky features that are built into most HELOCs, and they can catch even the smartest homeowners totally by surprise.
Let's talk about the first and maybe the biggest trap. You should think about the beginning of a HELOC like it's a credit card with a ticking time bomb attached. It seems so easy and affordable at first, but there's a huge change that's literally hard-coded into the loan from day one.
So here's how they get you. Most HELOCs give you a 10-year draw period to borrow money. And here's the key. During that time, you're usually only required to pay the interest on what you've borrowed. This keeps your monthly payment feeling artificially low. But when that decade is up, you hit what's known as the repayment cliff. And this chart shows you exactly what that cliff feels like. Let's say you have a $60,000 HELOC at 8.5%. Your interest-only payment is about $425 a month. Pretty manageable, right? But then, bam, the repayment period kicks in. All of a sudden, you have to start paying back the principal plus the interest. That same payment could jump to over $520 a month, maybe even more if rates went up. That's a serious payment shock. Now, the second trap connects your loan directly to the health of the housing market. Always remember, your HELOC is backed by the value of your home, and that value is absolutely not guaranteed to keep going up forever.
I mean, look at this. After years of a red-hot market, things have, well, they've cooled off. A lot. We've seen major markets like Austin and Phoenix where home appreciation has basically flatlined or even gone backward. When you borrow against your equity and then the value of your house drops, that cushion you thought you had starts to shrink. That makes the bank nervous, and in some cases, they can actually freeze your line of credit.
All right, trap number 3. This one's not about math or spreadsheets. It's about what's going on up here in your head. It's all about how these things make us feel and how that feeling can lead to some really bad financial choices.
And here we are, right back at this powerful idea. Because the loan is attached to your house, your brain does a funny thing. It stops feeling like scary, leveraged debt, and it starts feeling more like a checking account you can just pull from whenever. This little mental trick makes it way too easy to use your home equity for lifestyle stuff, vacations, new cars, things that don't actually add any value back to your home.
Okay, so if HELOCs are this tricky, what are you supposed to do? It's not about saying you should never borrow money. It's about choosing the right tool for the right job. So let's look at some other options. This is the big question, right? If a variable rate HELOC feels like walking through a minefield, what's the safer path? Well, you have options, and just understanding what they are is the first step to making a much smarter choice.
Okay, let's break this chart down. The first thing you should notice, that column, your home at risk, yeah, that's a big one. A HELOC, a fixed-rate home equity loan, a cash-out refi, they all use your house as collateral. A personal loan? It doesn't. Now look at the rates. A HELO and a personal loan, they often come with a fixed rate. That means your payment is predictable. It's not going to suddenly triple on you.
And honestly, this is so important right now. A fixed-rate loan might not seem as flexible, but in a crazy, uncertain market, that predictability is a huge benefit. It completely eliminates the risk of that insane rate whiplash we saw earlier. So before you even think about signing any paperwork, I want to give you a practical 5-step toolkit you can use to really stress test this decision for yourself.
Seriously, just go through this list. Step 1, get a real appraisal, not just some online guess. Step 2, do the scary math. What happens to your payment if rates jump another 2%? Can you still handle it? Step 3, compare to an unsecured personal loan. Step 4, ask the bank the hard question. Under what conditions would you freeze my line of credit? And finally, step 5, think about getting an objective second opinion from a fee-only advisor who isn't trying to sell you something.
Let's just be brutally honest about what's happening here. When you take out a HELOC, you are taking the equity you've worked so hard to build in your home, your biggest asset, and you are turning it into a debt, a liability. It's a powerful financial tool for sure, but it comes with some serious responsibility. And that leaves us with this one last question you have to ask yourself. When you think about getting a HELOC, is this for a strategic investment like a home renovation that's going to increase its value? Or are you just funding a temporary want? Because the answer to that question will tell you everything you need to know about whether you're building wealth or just setting a financial trap for your future self.